What's up, everybody? Welcome back to Wealth Not Wait. I am your host, as always, Joseph Quiza, and today we're doing something new and exciting and special and something that I really am happy and thrilled to share with you guys. This is the first episode of a new series I affectionately call Making a Mogul. Now, as you may and or may not know, the real estate sector and investing in real estate and land and all that makes the most millionaires, not billionaires. Billionaires would be financial services, but that's the one that creates the most millionaires compared to any sector. People who invest in real estate, who build real estate, who do things with real estate, that is the most millionaire wealth creator possible. And I know little to nothing about real estate. I know some general ideas. I looked at some properties, some land once. I had this, kind of idea and some outlines, but you learn as you go. I have a little bit of education on it, but not a whole lot. So I thought it would be fun to document the process of me learning about real estate, learning from actual real people, experts, either directly or indirectly through things like YouTube videos, self-taught kind of stuff, and investing in it with some unique new tools and apps and services, and sharing that journey with you guys, and maybe also helping you through your real estate kind of adventure, or teaching you something, or that you guys could take this journey with me, either directly by investing and doing things, in conjunction with it, or just by following along. Now, I also want to say that this is in no way, shape, or form any form of investment advice. I'm not saying this is what you should do. I don't know your situation, your risk tolerance, your knowledge, your financial, anything. I'm not in there with you and working with you to build things. This is just what I'm doing personally, and I'm sharing my education, my resources, my personal opinions, thoughts, and what I'm doing with you guys to see, hey, this is maybe an option for you, or something that you can learn and build and grow. And also a big advocate of self-education, as that's how I learned stocks. That's how I learned everything that I know that's genuinely important, is really through self-education. No one came and said, this is a class you have to take. I went out and either sought those classes or learned it through things like YouTube videos and books and whatnot. Also want to mention that what we're going to be using is a app that I've kind of looked into a little bit, and I've used it very basically for like a week. Nothing super crazy. It's going to be LANDA. LANDA, the app, it's where you can essentially buy shares. Being a stock market type person, I feel this makes it easy for me, and maybe you as well. If you're a retail investor, you can buy shares in investment properties. Now, I know that's something I was a little worried on. I know a lot of people are kind of outspoken about not owning fractional and share-based investments in real estate properties, but given how this isn't like the main thing on my portfolio, and I'm also learning and figuring it out, I'm going to take the risk and kind of like see, okay, is this something that works? How does it work? Is this a good service? I've also heard of Fundrise. A friend of mine put me on a Fundrise. There's some videos we're gonna watch about that and get some opinions, and I may try that as well. But for LANDA, if you use this code that I'm going to put here on the screen, you will get a $5 share of one of their many investment properties. With that, not only do I get $5 worth of a share of investment property, but you also get $5 share investment property. And we both have then a fractional share in a house. Maybe not the same house, maybe at the same kind of property, but they have a substantial amount of properties, especially for something that started not too long ago. It just began March of 2022, I believe. It's now July of 2022. So they're gaining some traction, they're building, and I see they're adding more and more properties pretty consistently at least. So if you use this code here, you guys get a $5 share, I get a $5 share, and we could grow and learn about this together. So we'll also learn about the app, so we'll grow and learn about the app to see if this is also something that's worth your time or that I will continue using. So we're gonna be documenting that course, and I'm gonna jump right into it. Now, first episode of Making a Mogul. The first video that we're gonna be watching is the Ultimate Beginner's Guide to Investing in Real Estate, Step by Step, by another wonderful YouTuber who talks about finances, only he's a little more popular and probably better than I am. Graham Stephan, been watching him a long time, a lot of good, great stock investment advice. Can't really see my eyes. But yeah, he's also made a lot of his money in real estate. So yeah, so we're gonna watch him. He has the ultimate breakdown. Just kind of get an intro into it. I think I've seen this video maybe before, but now we're really gonna sit down and start taking notes on it and try and get a good basis, almost like a real estate one-on-one type situation.
Prepare for and actually invest in real estate. With this, I'm gonna try to keep it as basic and
Just finished the Graham Stephan video, and something I noticed, a lot of it was about traditional real estate investing. And what I didn't know, and which I'm really happy that I'm starting to do this now, is that it requires a substantial amount of credit, a substantial amount of cash up front, and a substantial amount of borrowing and lending going into debt. Now, the cash up front part, I'm not adversely against, especially for someone who advocates for paying cash or not using credit cards such as me. I cancel my credit cards and all that. Obviously, Graham Stephan, someone who builds money through debt and equity and real estate, in the traditional sense at least, is big on that. And he does credit card flipping and all this other types of stuff. Good for him. It works for him. For me, I prefer to have the freedom to not do that. That's just my personal preference. You know, your results may vary. Traditional real estate investing requires a lot of that. You can't take off a substantial amount of write-offs because lenders don't like that. You have to get pre-qualified and use your lenders. You have to shop around for rates. You have to put in 5 to 20%. If you get your rates wrong, it's going to cost you tens, if not hundreds of thousands of dollars in money that you have to spend. Obviously, mortgages, you're making payments on things. There's a substantial amount of debt that's required. If your credit score is not good, you don't get your loan or your rate sucks, a whole fuck ton of stuff, but he's looking for the same way that I would look for stocks. It's almost like a value investment. He's finding underpriced properties in good sectors and good areas. So say Los Angeles, he used it. 5 minutes outside of Los Angeles, the properties there are significantly cheaper and they're more easily accessible. So he'll buy something there. It's only 5 minutes from Los Angeles, a high growth, high development area. Let's just say that he sees this area is growing, the prices are going up, but this little area outside 5 minutes away has remained pretty consistent. He will then invest in properties over there because he's getting a good deal, probably a likely better deal than he could anywhere else. And then eventually he's saying that if he has a good feeling that they'll trickle down and go over there now from Los Angeles as people move further and further out, that real estate will then become fairly priced because you're buying at an underpriced valuation, or overpriced in that the amount goes up and now that area is similar to like a Los Angeles or whatever, the example he used. For growth. I just found it funny how he did that the same way I do a value investing method. That's what I'm going to be doing with the LANDA. Obviously, it's locked into what they have available in the properties that they own, and they're selling out off for fractional shares. However, they're doing a lot in the near Atlanta area, Atlanta being a big area growing up. And I also noticed, this is just my personal thing that I've seen, they have a kind of circle around Marvel Studios, an area that Marvel rents and uses for their movies now, that a lot of it's being filmed in Atlanta. They have a really solid area around there. So that's a lot of growth, a lot of stuff coming to that community, especially as Atlanta and being a major city is getting overpriced and people are moving out. They have areas near close to that, a big movie area now that it's becoming this big, almost like the next Hollywood type thing within the coming years, as Disney and other people use that, along with Tyler Perry Studios. And then also people are moving out of Atlanta, then it's also that option of moving to something nearby that has a fair price. So that may also be a really good option to look at. They also have New York, and New York, of course, like areas like Brooklyn are very high priced areas, especially if you get a good home. The rent there is insane, and people are constantly trying to move in. You have a lot of the demand and high prices. That may also be something good to look into. So the next video I have is buying your first rental property, again by Graham Stephan, and this one's a little bit longer, so we're gonna get into it. And this is more specifically, I imagine, close to what I would be using instead of just buying a property outright. This is more like what to look for in a rental property, and I could use some of his tips and tricks to find a good rental property on the site. So after watching that video by Graham Stephan, that one also covered a lot of the things that I covered in the previous ones about getting your loans, getting your credit score and everything set up, but this one was a lot more in-depth on what kind of properties, locations, places to look at. Something he said a lot of, which I could apply now to the whole LANDA situation, buying partial shares of properties, is watching area, watching the growth, the development of it, finding, say, a house or something in an area that's fastly growing, a little bit outside of, ideally, say, like Atlanta or Brooklyn or something like that, where the area is growing pretty good, but not high traffic, like people can't sleep at night because there's fucking trains and highways and everything going around. Something along those lines is also very good. Checking for rental costs, make sure, because they're in charge of that whole situation. That and their management company, they're in charge of setting rents, establishing rents. Now, I believe they're a multi-million-dollar company. I imagine they would have something like that set up pretty correctly, but making sure that rents are within a fair price, something that's not outlandishly crazy as far as the high-end spectrum, or outlandishly crazy on the low-end spectrum, something that's a fair price, so that way it won't be hard to get tenants in and there's not going to be a lot of vacancies. Obviously, with rent and everything increasing, if it's already an outlandishly high price, probably not going to be rented very often, a lot of vacancy, therefore losing money. If it's a lot of low prices, probably get a lot of tenants, not vacancies, but then you'll be losing a substantial amount of money that you can make. If it's 60% or something crazy below market average, 20-30% below market average, then maybe looking at a property that charges a fair market price would be better, not something that loses money, because every percentage counts. If you have a lot of money invested in something and you increase it by a percentage that you're making, that could be the difference between $1,000 to $100,000. Again, depending on how much money you have invested. Something else I have to look for is the home itself, the price that it was bought at. I believe some of them they own outright, other ones they're paying a mortgage, checking interest rates and making sure that they got something for a good, solid deal, not that they're paying an extraordinarily large amount towards the mortgage and then a lot of fees and a lot of stuff coming out of it. What he mentioned was very important is cash flow. If you're not breaking even, at least breaking even, and owning the property outright after a couple of years or a couple of decades, he said after 15 to 20 years, if you don't own the property and they're at least paying your mortgage and everything to maintain it, and then you get essentially a free property out of it, then it's not doing good. I'm not going to be owning the property outright, or at least me, like as an individual. Well, maybe they'll do something where fractional ownership, if we own the property outright, along those lines. Being a fractional owner, I have to look at cash flow. Cash flow is going to be the important thing. Obviously, the share price is extraordinarily important. If we're going to be making money, if it goes from $20 a share to $100 a share, great. That's good. That's awesome. But also then along the way, getting those dividends, getting a solid cash flow, getting 6% or 12%, something above market average of 10% would be great. But making sure I'm doing that. And along with the home itself, if they eventually sell the house, if they do something and I have fractional shares, then I have to make sure and check on how they're going to set it up, some of that based on how much ownership or the share price or however it works out. Anything like that, making sure that the house itself is good, that people want to actually be it. It's a good area. That the house isn't something that they're going to have to invest a lot of maintenance into. If I look and I see like this place kind of fucking sucks, I know that maintenance costs is going to have to be increased over time, therefore cutting into cash flow, therefore cutting into the share price, because the people are going to want to buy a house that sucks. So people are going to want to invest in those shares. It's a mix between the stock market and then the real estate itself is kind of what I'm seeing here. Almost a split, less a red and more of like individual, as what I imagined I was getting myself into. More of it was like a mix between stocks and real estate itself. So I'm interested to see how this all turns out. I'm going to do a lot of heavy research in the next episode. This episode is going to be coming to a close. Probably put some money into the account and do some heavy research into areas, along with looking into potential things like what kind of homes in Brooklyn would be good, what good areas are there, doing some research into it and finding a good investment property to put my first investment into. So if you guys like this video and you want to see more of Making a Mogul, make sure you guys like, comment, and subscribe, and I'll see you all next time on this real estate adventure. Peace.